Hey, my name is Oliver, and I want to make this video because I think I have a good answer to the question about Newcomb's paradox. I have a background in finance and I'm currently working on an MBA, and I've also had a master's in data analytics before, but I just wanted to kind of provide my thoughts about this problem. And the problem is about having two boxes on a table. One is a known entity with $1,000 inside the box, and the other box is a question mark. And basically, the question is, I'm just going to run through also some of the other details. You have a supercomputer that's predicting the outcome of the decision you're going to make, and the computer's judgment of what your decision is going to be is going to determine how much you're gonna potentially earn in this scenario. Okay, so again, there's two boxes, one with 1,000, one with a question mark on it. And let's see. Okay, I'm running through the video again just to make sure I get it right. Okay, we got our $1,000 in one box and the question mark on the other box. Okay, so the supercomputer is very good at predicting people. It has correctly predicted the choices of thousands of people and the problem you're about to face. You know that it's, so here's an important fact. The computer has almost predicted the correct answer every time. However, I haven't looked at the original problem, but it's making that kind of minor distinction. It's saying almost every time, and it's correctly predicted thousands of times. So we're not exactly sure what the percentage of correct answers is the computer is giving, but we know it's a high percentage. So let's just assume it's like in the greater than 90% range, let's say 95%. But we can't really, we don't know for sure. Okay, so it's saying we can take the mystery box or, okay, here we go. So before we walk into the room, before we walk into a room with the two boxes, the computer's already making a judgment about what it thinks about what our decision's going to be. And I think that's also a critical component that I'll get to later, and that will be about trust. So part of our judgment over the calculation of this will be how much do we trust the computer's judgment about all the facts it's weighing into this decision for us. And that's going to be one of the few elements that comes into what I think or what objectively are the right decisions about what to do here. Okay, so the computer's predicted what we're going to do before we walk in. It's saying if we pick the question mark and you leave $1,000 on the table, then it'll put $1 million. So if the computer predicts you're going to pick the box with the question mark on it and leave the $1,000 box alone, it's going to put the $1 million inside of the question mark box, regardless of whatever decision you make. So it's already made this decision about some quantity of data that represents who you are, and it's determining that if it's made that judgment that you're going to pick the one with the question mark, it's going to give you $1 million. Okay. All right. So that's out of the way. Okay. But if the supercomputer predicts you're going to pick both boxes, then it puts nothing in the mystery box. Again, so two outcomes. It either predicts you're going to take both boxes. If it does predict you're going to take both boxes, there's $0 in the question mark mystery box. If the computer has determined you're only solely going to take the question mark box and not both boxes, again, one box has the $1,000 as well, that's a known entity. But if you're only going to take the one question mark box and leave the $1,000 box alone, then then it's $1 million in that question mark box. But if you take both boxes, it'll obviously, if the computer is predicting you're going to take both boxes, it'll put $0 in the question mark box and put $1,000 in the retained amount of the $1,000 box will continue to be $1,000. Okay, I probably could have explained that a lot better, but it is what it is. So now to kind of think about how we're going to approach this, One, again, like I mentioned before, it's how much credence or how much trust we build into the computer's prediction model. This is supposed to be a super smart computer, so we're erring to the side that it's going to be a high predictability rate. The second component now, this is really a question, to simplify it, it's really a question about risk. So it's your risk assessment profile. So this question actually happens in the real world all the time. For example, the portfolio weighted structure of your investment account. The more that's allocated towards safer, less risky assets such as treasury bonds that have more of a guaranteed return, it's a more of a known entity outcome that if you know you're getting a certain rate of return on those bonds, you as a risk averse person, for example, would be allocating more of your resource into a safer investment strategy. If you're taking a more aggressive weighted strategy towards stocks, for instance, then you'd be weighting your portfolio more into stocks. And in the real world, this has more to do also with like your age and your time horizon of the investment. So it's more, there's a culmination of factors, and it's not a binary outcome. It's you're diversifying your portfolio in multiple ways. So, long story short, in the real world, this is a diversified solution where you're risk weighting your assets into different investment strategies. And of course, like the pure mystery box answer would be something like, I'm going to put all my money into Bitcoin, for instance. That would be like saying I'm all in on the question mark in the real world. So, the interesting thing I think about the equation isn't so much the $1,000 and the question mark, it's that there's a threshold that every person would have when it comes to the known entity that would determine what outcome they're going to choose. Right now, we're just using a static scenario where it's always going to be $1,000 in the other box. But realistically, is a real more interesting question is what dollar value threshold needs to be in that known entity box for you to decide what your actual decision is going to be. For instance, if someone has $1 million in their bank account and let's say they're a more aggressive risk taker mindset, that $1,000 isn't going to mean much to them unless they're just thinking about gamifying. Like they just like to win and they want to pick, if their intention is to actually generate income or cash flow from this scenario, which probably it would be because that's what they're incentivized to do, then they'd be looking at that $1,000 and saying, that's not enough for me to be willing to this is another component of risk is the risk of what I would have earned if I had invested into the other outcome, which is, if I had picked the question mark box, I could have earned something that would be a high, significantly more value to me. So basically you've got the $1,000, you've got the question mark, and in this, in example one, you've got $1 million in your bank account and you're more riskier type investor or person. And when it comes to finances, so you're probably more thinking that you're going to take just solely the question mark box in this scenario because that has a higher return of value to you. If that's your calculation and you're assuming this computer is in line with your assumptions, and I think the reason you can't simply say that you're looking at it as you're trying to do a comparative value analysis where it's like, well, if I take two boxes, then I'm always guaranteed $1,000. If I only take the $0, the question mark, then I might come up with zero. Because the other component of the strategy, I think that would be true if it was a random outcome in the question mark box, if it was, a probability assessment. But in this probability assessment, we have a computer that's making that judgment about how you're calculating your own predictable outcome. So in terms of a mathematical model, that a model would be based on this person's risk profile, and which was one component, and based on this person's, let's say their net worth, so that their net worth and their risk profile, how much money in the known entity box that right now has $1,000, what does that quantity of money have to be before they're switching their decision from the question mark box to both boxes? Because again, the risk in taking just a question mark box is that it could be $0 if the computer thinks, hey, the number in the known entity box has gone up high enough that the person's not going to be willing to risk that amount of money to gain whatever's in the question mark box. So let's say, okay, you've got $1 million savings, you're a highly risky investor. Let's say now the amount in the known entity box is $100,000. So now you're really thinking, am I really going to risk picking a question mark that might have $1 million in it versus a known quantity of 100,000 in the other box? And in this case, very likely you've crossed kind of this threshold where it's like, I'm going to go with the solution, and you're also weighing into the consideration of how accurate the model is. So most likely at that point, for most people, again, not everybody, but for most people in that scenario, they'd be thinking, okay, I'm going to take both boxes. Have at least a guaranteed outcome of the 100,000, and the question mark box would be just a bonus. Like if the computer assesses my risk profile as something more than it is, then I'm going to even further amplify my earnings because I'm going to get whatever, the extra million on top of that. So it's really, it actually is going to push that curve even lower for that outcome, because now you're also thinking, hey, this computer might be thinking I'm a riskier person than I actually am. And if that's the case, and it is happening, because it does say it does from time to time, the computer assesses incorrectly. So there are those instances where the computer might think you're willing to go for the question mark, more aggressively than you actually are. And then in that case, you're actually you're getting a huge return on that scenario. But anyway, so a couple more examples. Like one example, which I think is interesting, is like, maybe not actually interesting, but from the computer's perspective, because again, the way that they're describing this computer is it's a computer that has no predilection. It's not trying to trick you. It's not a self-interested computer. It's not, and I think this scenario mimics the financial markets. I think is a good way to say, like, what is in the real world, what does this supercomputer represent? And in this case, maybe it's the financial markets, judging what investors are doing with their money, institutions, and how they hedge against the different strategies that are happening in the marketplace. So, however, in that case, those institutions and that market as a whole is more acting out of self-interest rather than just a kind of like prediction model. So back to the example, if you've got $999,000 in box one versus the question mark box, obviously at that point the model is broken, because there's no logical reason to take the question mark if your only net potential gain is $1 for all that risk. You risk losing $999,000 to earn $1, and it's very, very unlikely the computer is going to think you're going to make that selection anyway. So again, there's this certain threshold in the line based on your risk tolerance profile, based on your also, the reason I say based on your net worth is because I think this on a macro level would be a good assessment of the health of an economy. So in good times, people are going to be a higher risk profile. So like if they have a little bit more savings in their account when things are good, when they're making more income at work, they've got more disposable income, they're going to be willing to risk more for that mystery box, thinking, hey, if I get whatever's in that mystery box, I could be getting $1 million rather than, let's say, $10,000 in the other box. Like that number is going to be, that risk threshold, that quantity in the known entity box is going to go higher higher for what they're willing to do before they take the guaranteed 2 boxes. When times are tougher, that number is going to go lower. So it's going to be, less on average. It's going to be a lower amount that people are going to be willing to risk in order to get that $1 million. Of course, there are going to be outliers where it's like, things are tough, and I just want a big breakthrough. I just want to get that question mark box. So, there's always outliers, but statistically speaking, once you quantify everything in aggregate, it will alleviate outliers, and you just kind of benchmark based on what is the most probable weighted outcome of all people's profile and judgments. And that's essentially what statistics is simplified to, is that the more data you aggregate, the more you're going to get an outcome that is just right in the sweet spot, right, representative of every kind of decision along the scale of outcomes. So again, that'd be like some kind of mathematical probability outcome with a risk-weighted assessment of the risk profile versus the net worth. Some combination of those two, like multiplied, would be the probability outcome of the selection process. So I think that's really what this is. Again, simply is it's a risk. It's a question of how much are you willing to risk to earn this question mark amount of money. And I think it would be an interesting thing to have in terms of the public's response generally. Like, what would that number have to be in that $1,000 box that it currently is? What would that number have to be for you to, take that known quantity of money rather than risking it for the $1 million? And then also knowing that potentially the computer is incorrect and you're actually doubling up on your outcome. So yeah, I think it's an interesting problem, and that's how that's my response. And yeah.